Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 21st of May. There was a bit of a hiccup during the week associated with what's going on in Washington at the moment with Trump's supposed links to the Russians. The market had been resisting that for several weeks, but there was finally a trigger and we had a bit of a sharp sell-off on Wednesday, but the market immediately recovered to again just display how much underlying buying support there is. In the edition this week, I want to touch on risk and reward because I have been having some communications with several people of late about performance of markets and where risks are laying. So I thought that was timely to address this question. So let's jump in, and I just want to make some preliminary observations about why markets are rising. A lot of people have been scratching their head now for several years, wondering why markets just keep going up and up in the face of these massive debts that governments and countries all around the world have amassed, and all the other things in the wall of worry that they concern themselves with. So I thought it was timely just to look at this. So there are some good reasons why markets are rising. Some of the really important fundamentals, we've got good economic growth, and it's certainly accelerating in Europe. There's little question about that now. Europe is looking much better and is actually economically growing faster than the US. China, of course, people are always wanting to try and prick the China bubble, but I have no evidence to suggest that they're not going to continue to get through and indeed to flourish. The second good reason is that corporate profits are increasing, and at the end of the day, the price of a stock long term is a reflection of the growth in their profits and their ability to provide a return through dividends or other means to shareholders. And that's what stocks are priced on. In the short term, prices move around for a whole bunch of other reasons, sentiment, and perhaps short-term drivers, but that's really the long term, and that's what will always come back and be applicable. Thirdly, there are some massive demographic drivers for some sectors, particularly around technology, mobile payments, mobile entertainment, driverless cars, the Internet of Things. There's just so many aspects to the technology revolution and so many demographic drivers that it's really hard to see how the growth in that sector is going to be impeded. So they're the good reasons. Now, there's also some bad reasons why markets that we don't really want to see markets going up for these reasons. The first one is over the last couple of years, there's been a tendency for central banks and sovereign wealth funds to start heavily buying into stock markets. Now, as you would know, central banks have been buying up bonds for the last 5 or 6 years, and they bought up bonds to such an extent that they drove interest rates down to zero and even into the negative. They've now changed tack and they've stopped that process of buying bonds like there was no tomorrow, and instead they've found another way to inject money into the economy, and that's just basically to support the stock market and create a wealth effect. And I've made reference to this before, that the Japanese central bank owns a meaningful percentage of virtually every stock in the Nikkei 225 index. And so when a central bank is quite possibly the major shareholder in a stock market, I can't see that it's a particularly healthy thing. So we're seeing that in various countries around the world. The second bad reason is that we've had this amazing growth of index tracking funds. And so what that has done is created a bit of an upward spiral that tends to feed on itself. And you've got to ask the question, is fundamental research dying in terms of looking at the merits of stocks, looking at valuations? Are those things being cast out the window? And many funds now are just basically taking their cues from this robo research that's available out now. It's all being driven by computer algorithms. And I get the sense that there's a bit of a shortage coming up of analysts who actually look at the markets in context and provide you with their view on what's happening. There's just so much being done these days by automation. And the other bad reason, of course, is that we get excessive expectation for the future. And certainly there's been some expectation built into certain sectors of the American stock market on the basis that Donald Trump would get various policies through which would have a very positive effect. I think it was reasonable to price some of that in because he still has a good chance of achieving some of those things. But it's just a matter of whether there was too much expectation. So both good reasons and bad reasons why markets are rising, and this is where it's important, where I think a human being who's got experience and skills and can actually provide a value opinion as to what's going on is so important, rather than just a computer algorithm which may give you an answer that's not in context. Now, I just want to touch on understanding investing. Again, this gets back to some questions that I've had recently about past performance and risk and return. Too many people focus just on the absolute return of a fund or whatever it might be, or a particular market or an index. And I guess that's just human nature, seeking to take the easy path. If you take a set of results and they were good for the last couple of years, then they're likely to be, good into the future. And that's it's not as simple as that. So for a lot of people, they just want to know about past performance. Just give me a number and give me a prediction for the future. And, that's it. And they get on with their life. Unfortunately, investing is not that easy. And it's really about the potential return for the risks that are involved. And the vast majority of people are not looking at the risk side of the equation. So these are just some aspects to consider. Someone has to do the research to separate the good opportunities from the looming disasters. And I'm not at all comfortable that a computer algorithm can look at all the possible circumstances and reliably give you an answer as to getting that balance between, the good opportunities and the looming disasters. Personally, I'm not prepared to put my faith in a computer algorithm that it's going to come up with the right result. And if you just blindly follow that sort of research, then you may or may not get the outcome that you want. Secondly, someone's got to be able to read price charts because fundamental analysis only is always going to lag the current market by many months. Prices are going to start to move because the insiders understand what's going on within particular companies, and that's going to be reflected in price charts. And if you're good at reading price charts, then as well as doing fundamental analysis, then you've got a huge advantage, I believe, on the people that are using fundamental analysis only or the computer algorithms. Someone has to be able to realistically gauge risk and return in the context of what we're seeing at the moment. And you've got to look at you can't just look at stocks, you've got to look at bonds, you've got to look at commodities, you've got to look at currencies, you've got to look at the whole asset class, and you've also got to take account of some geopolitical risk as well. So somebody's got to be able to realistically put that information into context. And then finally, you need the discipline to only act when the balance is favourable. And the way that funds and the management of funds works these days, there's too much buying towards the top of the market and too much redemption and selling towards the bottom of the market when people panic, and the fear and greed trade just keeps playing out over and over. Those that can step aside from that and cultivate the discipline to only act when the balance is in your favour are always going to have a huge advantage. So the investing reality is this. Your choices these days are so vast compared to 10 or 20 years ago. You don't have to accept the risks that most people blindly accept or unknowingly accept because they're just doing things that have always been done. They're sticking with the household names. They're sticking with the top 100 stocks when a lot of those stocks are basket cases and have gone nowhere for a decade or have gone into decline. You don't have to do that anymore because your choices are just so immense. There are sectors that you can choose from. You don't have to be in the entire market. You can choose sectors that have got an almost unassailable long-term driver. And I mentioned some of those at the start. You've also got ETFs that allow you to reduce stock-specific risk. So you buy a basket of stocks, and that eliminates any one particular stock going off the rails. But you've got to be very aware of liquidity and the structure of the ETFs. Some of these ETFs are quite dangerous because they're not liquid and they're structured in such a way that you can easily get a trigger that can blow them up. Now, some ETFs are great. Their liquidity is extraordinary. Their turnover is in tens of billions of dollars a day, and they reflect some of the biggest companies on the planet. Those ETFs are going to be fine, but there is just so many ETFs. There's about 3,000 ETFs in America alone. Some of those ETFs are going to blow up, so you do need to be careful. In the future, we are going to see the unwinding of some funds and ETFs, and it's going to be ugly because as they've embarked on an upward spiral with higher price rises causing more money, causing more price rises that feeds on itself, that spiral is going to go into reverse. And so we're going to see some ugly situations in the future, and those that just blindly walk into buying ETFs without consideration to structure and liquidity are going to get some nasty surprises. But look, it's straightforward to avoid this. Every month or 6 weeks, I go through that exercise where I look at the S&P index and what a top looks like, what a change of character in the market looks like. It's straightforward to avoid these situations. So again, for those of you out there that agonize about the next crash, just relax. If you're plugged in yourself or you're plugged into someone that's watching it, you will get many months of forward notice. All right, sorry, a bit long-winded, but I think they're really important issues for you to understand. And they're so important that I'm actually going to produce a little video during next week on past performance. Some of you may be aware I've got a series going at the moment, and I'm just going to plug that extra video in because I think it's such an important issue. Turning now to the actual performance of the market last week, the S&P declined by 9 points on the week. That was following on from another 8 points the previous week. We got a somewhat unexpected but inevitable downdraft. I guess something was always going to prick the market, and then the computer algorithms would kick in and drag it down more sharply than needed to be. But I guess it was unexpected in the sense that the Wall Street had been ignoring what was going on in Washington for many weeks and months, and then finally there was something that caused that little downdraft, but it was one session only, as we'll see from the chart. So I think on this particular issue, it's a bit of a storm in a teacup. However, the important question for markets now is that Trump policy on tax reform, on healthcare, on borders and immigration, they're almost certainly going to be delayed while all these investigations occur. Now, what had happened, of course, since November is that the market had started to factor in a premium on the basis that Trump policy would get through. So the question now, of course, that no one knows the answer to is, will that premium be removed from the market, and how much of that premium will be removed from the market because of the delay in Trump policy? So that's the $1 million question, and we'll just have to wait and see how that unfolds. So for me at the moment, there is in the short term, there is some headline risk, the headline risk being just basically news stories. And they're not going to change the trend, and the trends remain intact. So I'm not changing my tune one little bit, but I do acknowledge that in the short term, things could get a bit more volatile. We did see the US dollar fall quite sharply during the week, and that's interesting, and we'll have a look at where the US dollar is likely to find support. So let's jump in and look at the S&P index first of all. You can see the green box there. I haven't moved that. That was where I had the green box last week prior to, so this was where the green box was when the market was sitting here. I indicated that that was the zone of a pullback that I was looking for. As you can see, the market dipped on Wednesday quite sharply and went pretty much into the middle of that box. It gapped down a little bit further on Thursday morning, but then you could see finished up strongly on Thursday and again followed through nicely on Friday. So there's no change in character in the market. We're still above the 50-day moving average. The 50-day is miles above the 200-day, so all that's indicating continued strength in trend. And you need more than one sudden down day like we got over here, one down day and then a bit of sideways and then up again. You need more than that to change the character of the market. So from my perspective, absolutely nothing has changed there whatsoever. If we look at the US dollar, sorry, let me just get the US dollar up. There we go. So the US dollar, as you can see, we got up above the $100 resistance level, got up to about 103.5, mucked around that key resistance level for some time, and then we've broken this channel and we're heading back down to a lower level of support. Now we've got some support here at around 96, and then we've got further support at 94 and 93. Now, of course, the falling US dollar has been a bit helpful for commodities, and it's also pushed the Australian dollar up a little bit as well. I'll also just touch on the VIX index as well. So we got a little bit of a spike. This is the VXO. The VIX index itself is a little bit higher, but this one will do. And if we pan back, you can see that we got a little bit of a spike, but look, it's barely moved the dial in terms of moving it out of that long-term base that the VIX index sits in. So very much a one-day wonder, Wednesday of last week. Turning now to the Australian market, the Aussie dollar bounced about a cent because of the weaker US dollar. We're now back to the top of the new lower range. So we're in a band between 74.5 and 78. We've now moved down into a lower band, and we're bouncing around within that lower band now. The Australian index had a bad week, down 110 points. That part of that was the bank levy, and of course the banks form such a high proportion of the Australian market, but that wasn't the only story. There is a bit of a rotation going on at the moment, though, from banks back to major miners. This sort of thing happens all the time. I don't believe the banks have got a lot more downside in them in the short term, but neither do I think they've got a lot of upside either. So stock selection is really vital, and the best performers in the Australian market, there's just no question about it, you won't find them in the top 50 stocks. You've got to go looking elsewhere. You've got to be very careful. There's a very, very clear and detailed template that I use for fundamentally analysing stocks that revolves around the growth in earnings, around the organic growth of the company, around debt, and around the main industry drivers for that sector. So you've got to do your homework. You've got to combine it with good charting techniques, and you've got to be very patient, that's for sure. Turning now to precious metals, gold, of course, went up with the the little bit of a fear that moved up in Washington during the week. Gold was up $28 to $12.56. And importantly, it's bounced back above that key 200 200-day moving average. For those of you that don't know much about technical analysis, that may not make sense. It might seem like a bit of black voodoo, but it is a self-fulfilling prophecy, and there are millions of technical traders around the world that will buy or sell on the basis of a stock or some asset either being above or below its 200-day moving average. That's just the reality. It becomes a self-fulfilling prophecy. So you can either agree that it should be or not be, but the fact is it is, and lots of people take their cues from that. But the important thing is that when we look at the chart, you'll see that gold has formed a higher low. And if we look at the weekly chart, there's been quite a clear reversal. So positive signs for gold. And I can't tell you what it's going to do in the very short term, as in the next few weeks. But for me, I'm comfortable that the medium to longer term path is upwards. Precious metal stocks are still being held back a bit by this GDXJ effect. If you don't know that story, you might want to Google it. But basically, GDXJ, which is the global index for the main junior miners, really got too big for its own success. It was so successful and so much money poured into it that it actually put the fund in a position where they had to heavily sell off some of their stocks. So it had nothing to do with the stocks being overvalued or fundamentally weak. It was just a structural issue. And these are some of the things that I was referring to earlier with respect to indices and ETFs. You just can't blindly wander in and not understand what's going on. So let's take a look at gold first of all. So this is gold on a weekly basis. So here's the first higher low. So we've got a low here, we've got a low here, we've got highs through here. So we've got higher highs. We've now had a pullback. We've now got in a shorter time frame, we've got a higher low, we've got a higher low, we've got higher highs. We have unquestionably we have an uptrend in the short term, and we've also got an uptrend in the medium term. Now we need gold to move back above around 1380 for that to continue, and we might bounce around here for a while. Can't comment on the time frame under which this will happen, but you can see that the 200-day moving average has flattened out. The 50-day is above it. The price is now back above the 200-day moving average. This is in positive orientation mode. That's really all you can say about it. So a very, very strong day on Wednesday, as you can see, when the stock market fell off, reversed a bit on Thursday, but went back up again on Friday, and that's really the US dollar effect, even though stocks were in much better shape. Silver had a reasonable week, has dipped fairly heavily, and that's associated with just the incredibly excessive buying in the futures market. Had just become far too optimistic, and that premium came out very savagely. Looking at GDX, the main stock index, where if we pan back, you can see we're just in a band now between around 18, about 19 roughly, and 26. I would expect to see, if gold continues to firm, I would expect to see this start to trend higher again, and we need to see it break across $32. So that's precious metals. Turning to other commodities, copper edged up a little bit again on currency effect to 257. Crude oil also rebounded to just over $50. That was a combination of currency and the Saudis and the Russians, talking about some more production cuts. But I think it's safe to say that you can expect to see oil continue to struggle a little bit. I wouldn't be surprised to see another visit down into the mid to low 40s, particularly when we get a bit of an inevitable rebound in the US dollar. The thing to do with the energy sector is watch the stock prices, because the stock prices are going to lead, and we could well get a situation where stock prices start to move up, even though oil is going down in the opposite direction. So we're not there yet. I'm still optimistic long term for the sector, but I'm very cautious in the short term. There's the spot copper chart. And just to wrap it up, this is pretty much the same slide as we had last week. Nothing has really changed, and certainly Wednesday didn't change anything for me. The S&P is threatening a breakout, but it does need to get on with it. The longer the market hangs around this 2400 level, the more susceptible it is to some computer algorithm selling. Otherwise, there's really no change. You should stay invested. Certainly the political theatre going on in Washington doesn't change the market direction, never has, never will. It just causes some short-term disruption. You want to focus on adding on dips, so just all the normal sort of stuff. Focus on the best sectors only. Investing and trading, it's not hard. It's only your emotions that make it hard. And just forget the general market noise, the general market, I should say. So I don't believe you should be targeting the stock market as an entity. I think you should be very focused on just the best sectors with the best outlook and find the best stocks within that sector. And just ignore all the other noise, and particularly ignore the press. If you're reading stories and following the press about the stock market, just understand you're dragging around a ball and chain, because it's putting things in your mind that really aren't at all helpful. So that's it for this week. I think some really important issues that I've addressed, and as I mentioned, if you do receive the current series that I've just started on investing, then I will put an extra video in there during the week on the whole issue of past performance and risk and return. There's my contact details for anyone that wishes to communicate with me, and I'll be back with you next weekend. Cheers.